Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of our informative video is health saving account explanation, in which we will discuss how to use a health saving account for tax-free investment. So first of all, health saving account are saving vehicles that offer tax benefits and can help you cover what may be your largest expense or in the retirement or in the healthcare. So, what are the key takeaways in this case? The first one, you have to keep in mind that if you have a high deductible health insurance plan, you may be eligible for a health saving account HSA, which is also known as the HSA. So, the second point which you have to keep in mind is that the tax advantages of the health saving accounts make them a great long-term saving vehicles and a smart way to prepare for medical costs in the retirement and reduce tax liability. Then you can use HSA funds tax free for qualified medical expenses either in the current year or in the retirement. So, when it comes to the big expenses in retirement, there's a fun stuff membership in a golf club, bucket list vacations, and spoiling your grandchildren. But for many retirees, the single biggest expense is less exciting to plan for healthcare costs. So, if we talk about it, then an average retired couple, both age 65, may need approximately 3 lakh and $15,000 in after tax saving to cover healthcare expenses in retirement. As people live longer and healthcare cost inflation continues to outpace general inflations, it's more important than ever to prepare for such expenses. And it's also very important to also protect your financial security through your golden years. So for this, for many, that upfront plannings include the use of health saving accounts, also known as HSAs, and often misunderstood saving vehicle offered in certain employer-sponsored health insurance plans. HSAs can be good saving vehicles, but they can also be confusing. Also confusing in such a way, and even savers who use an HSA may not be getting all their potential benefits. Here's how you need to know. So first of all, you have need to know that what is an health saving account. Health saving account are vehicles that offer our triple tax advantage. The first one is contributions go into the health saving account tax free. If you make contributions through payroll deductions, they are also not subject to the social security or the Medicare taxes. The second point is you can invest that money and enjoy tax free growth potentials. The third point is that withdrawals for qualified healthcare expenses does not incur taxes. Under the IRS rules, you can talk about that you can open and contribute to an health saving account only if you are enrolled in a high deductible health plan. In the recent years, more employers have begun to offer high deductible plans, with about a third employer that have health benefits now offering this type of plans to their workers. So these health plans tend to have relatively low premiums and higher out of pocket expenses, which the health saving account may help offset. People often see high deductible and get scared away, but you can say it's worth a conversation with your financial advisor about the financial benefits that the health saving account can offer. Say Dana Adfarb that executive director, HR, benefits planning and management at the Morgan Stanley. And it's also extra retirement account if you're already maxing to your 401k contributions. Your health saving account can serve as another place for you to save for the retirement, while that wealth as way to help people manage cost of high health insurance deductible. They also provide an opportunity for long-term savings. Unlike money is in a flexible spending account (FSA), health saving account funds remain in your account from years to years if you don't spend them, and you even retain ownership of the account if you leave your job or switch health plans. That means any investment earnings in your health saving account have the potential to grow for decades, effectively creating an extra tax advantage retirement fund in addition to your 401k plan and any of the IRAs and that you can mark for healthcare expenses later in life. You have to keep in mind that though that even if you switch from a high deductible health plan to another type of the health plan, you will not be able to contribute further to HSA until you are once again covered by a high deductible health plan. You can, however, still use to pay for qualified expenses for 2024 tax year. You have until tax day 2025 contribute to an HSA account up to $4,150 for the individual and $8,300 for families, while individuals age 55 and or older can save an additional up to $1,000 per year in catch-up contributions to an health saving account. You may also get some help from your employer. In 2023, employers contributing to the employee has account gave an average $726. Please note on Morgan Stanley does not seeds health saving accounts. So paying for medical costs along the way, if you use after tax dollars to pay for a big ticket health expenses now, you can also save your receipts to give yourself a windfall via tax-free health saving account reimbursement years or decades later. Even if you choose to use the money prior to the retirement, you have the flexibility to submit claims for qualified healthcare expenses that you've already paid out of pocket since establishing your HSA health saving account and get reimbursed whenever you want. Says Jennifer Kakitor, Executive Director, HR, Retirement and Investment for Morgan Stanley. In addition to medical expenses, health saving account can cover dental and also in cost. While you are not allowed to contribute to an health saving account once you have enrolled in Medicare, these accounts offer new benefits in the retirement. In addition to use your health saving account for qualified Medicare expenses after age 65, you can use it for non-medical expenses without penalty. And though you will have to pay taxes on those withdrawals if you I use it for non-qualified expenses before age 65. You'll owe taxes and a 20% penalty. And unlike 401k plans and traditional IRAs, health saving accounts don't have minimum required distribution, so you can keep your money in a health saving account until you're ready to use it. Consider the big financial picture. Most health saving accounts providers allow account holders to invest their holding once they reach a certain balance, just as you have a limited set of investment options to choose from in the most 401k plans of yours, and your HSA provider typically offers a predetermined list of the investments. So that was all about the health saving account explanation, how to use a health saving account for tax free investment. So I hope this video will be very beneficial for you. So do like and subscribe my channel for more further informative videos. So goodbye for till now.